Hello friends, today moneycontrol.com reported that a SEBI recommendation committee has suggested that F&O lot sizes be changed from current 5 lakh rupees per market lot to between 20 to 30 lakh rupees per market lot. That is 4 to 6 time increase in market lot sizes, and they've also suggested some other changes which we will discuss in the process of this video. Now, if you remember, in the recent past, I had recorded this video and I had told you that it is not necessary that SEBI or the finance ministry would impose direct taxes onto F&O trading. There could be indirect methods of controlling F&O by way of increasing the lot sizes. Hey, I was prescient, all right? You would be guessing, hey Vijay, how did you manage it? Because we've seen this in 2015. I gave you a brief history of how lot sizes were increased, span margins were increased, exposure margin thresholds, which are telescopic in nature, were compressed, so exposure margins kicked in earlier, and collateral margin laws were changed, peak margins were introduced, and stiff penalties for not meeting these exposure margins were introduced. This has all happened between 2015 to 2021-22. So now that SEBI is recommending, the committee rather is recommending that F&O lot sizes be raised from 5 lakhs to 20 to 30 lakhs. Secondly, there should be only one expiry per week per exchange in any derivative contract. Currently, you have multiple indices having expiries on unique days of the week. So it becomes very hectic for both the exchanges and the traders. Volatility goes up and down. Thirdly, they've recommended that collateral, the percentage of collateral that can be used instead of cash for span margin, be reined in by way of haircut. Now, what is a haircut? Supposing you give 1 lakh rupees worth of securities as collateral or pledge, the exchange tells you currently, hey, we'll allow you to use this collateral only to the extent of 80 lakhs, which means 20% is your haircut. So what SEBI is suggesting is collaterals be given a higher haircut, number one, and number two, the number of approved securities that an investor or trader can use as collateral as a pledge be brought down sharply. Now, what will be the implication? It's very simple. You can't leverage as much as you could earlier. Now, this is something I had spoken to you about in my previous video here. Prescient, highly predictive, but it's turning out to be true. Now, whether it's all enforced in the recommendation form or it's watered down, I have no way of knowing, nor do you. We can only wait and watch. But this video is about what to do when it happens and how to get around to trading as usual. Friends, this video is all about finding solutions to what is happening and what is being proposed here. So stick with me. Now first see the implications. Number one implication, and this is the most important implication of them all, you will need higher capital, period. If your lot size is going to go up from 5 lakhs to 20 lakhs, 4 times more money. If your lot size goes from 5 lakhs to 30 lakhs, 6 times more money. And that is just span margin. You will need 4 to 6 times more money for even mark-to-market margin, because whether you like it or not, your exposure will go up 4 to 6 times. So both extent of money in both span and M2M will go up. Either you can take the pressure of higher demands of capital, or you can't. Unfortunately, there is no recourse. Do remember, number of approved securities as collateral will be brought down also. The second implication, and these are general implications, I'll come to specific implications also. You can't average as easily as you were averaging earlier. Now, when the contract size, the lot size was 5 lakh rupees, maybe you could do 1, 2, 3 or 4 lots. But now when the lot sizes are going to be between 20 and 30 lakhs, do you foresee yourself doing 3, 4 and 5 lots of 30 lakhs each? It'll become very difficult. Money apart, it's not just the financial capital. I have made a video about the emotional capital quotient, how a trader also needs emotional capital. The pressure on your emotional capital will be far, far more significant than financial capital. I am in the process of recording trading psychology videos in a big series, and I assure you, this is the kind of work that you have not seen in the YouTube domain in the past from Indian YouTubers. Bear with me, we are working on this series. Now, not just averaging, but getting out in bits and pieces or booking part profits will not be possible. Hey, when you can afford only one lot of 30 lakh rupees, how will you book part profits? Because you will be having a singular lot. So either you're in the trade or you're out of it. You're either right or you're wrong. That will be somewhat of a challenge. There are solutions, believe me. Don't just get depressed. I'm all about finding solutions. Friends, you know me as a statistical systems trader, and I'm all about finding messages hidden in the market which the market communicates as numbers. Now, the snapshot window and the tick list are primary tools that I use. I have even uploaded multiple tick lists of many securities on my free Telegram channel in the past. If you've not connected with me on our free channel, you pay nothing there. Please do. My contact coordinates are on your screen right now. I convey all my thoughts, my blueprints, my research, and even pivot levels, a lot of other statistical work there only on my Telegram channel. So if you are interested, do make it a point to connect. No trading tips, please. Now, the tick list that you're seeing on your screen, this shows the number of trades that are taking place, each one tick by tick. That is why it's called the tick list. What will happen when lot sizes are increased is that the refresh rate or the number of transactions that take place in every second will come down, which means not only is the refresh rate coming down, but the vertical spreads will also increase. What are vertical spreads? Allow me some time. I'm going to touch upon them. I will tell you what the vertical spreads are, what horizontal spreads are, and what the spread quadrant is. This is something that you must, my online family must know to read their screens. Otherwise, you don't really have much of a future as a trader. We talked about vertical spreads. Now, friends, the horizontal spreads. Look at the snapshot window on your screen. What you are seeing is buyers on one side and sellers on the other. They have entered their limit prices. The difference between the buyer's limit and the seller's limit is called the spread, the bid and offer spread. These spreads, the thinner they are, the better it is for a trader, because you can get in and get out with very small differentials, which means your take-home profits are higher. If volumes come down, the bid and offer spreads, the horizontal spreads, run a huge risk of becoming wider. So you might buy at 105 rupees, but because the spreads are very wide, when you sell, you might have to sell at 103 rupees. That's a 2 rupee loss. Earlier, it could be 25 paise or 30 paise. So your take home is always determined by your bid and offer spread. This is the first cost that you pay as a trader. And any business, including trading, is where a smart businessman keeps his cost low and profits high. So your first cost, the spread, runs a risk of widening. Are there solutions to it? Yes. Allow me some time and I will. Now, I promised you I would discuss what the vertical spread is. Now, the first bid and first offer, bid number one, bid offer number one, the difference is horizontal in nature. Now look at the difference between the first, second, third, fourth and fifth bids. This is the incremental price that people are willing to pay or to offer fresh shares at. This is called the vertical spread or the impact cost. In addition to a narrow bid and offer spread, I also want narrow impact cost. If volumes are going to go down, the impact cost will also go up in addition to the bid and offer spread. Which means if I've made an error in entering and I want to get out, I realize it's a problem, I want to get out, the difference will be big. I will pay a bigger penalty in getting out. My take home profit will be smaller, my loss will be bigger. Here again, there is a solution. So stick with me. Now put together, the horizontal and the vertical spreads are called the spread quadrant. Quadrant is as in 4. Bid and offer, vertical spread on buyers, vertical spread on sellers. So that's a quadrant. You must know how to master reading the quadrant, or else you are going to have a very, very tough time in this new evolving market, where by 2025 you're going to have a lot of international high frequency traders, algo traders, artificial intelligence based traders, and they'll give you a run for your money unless you're very, very quick and savvy with screen reading. Now, I've explained to you what the spread quadrant is. What about the order fills? Order fills are when you enter an order and it gets filled, means executed. Right now, because there's a lot of refreshing happening in the tick list. Remember, I told you that currently the markets are refreshing very, very fast. Now, if the bid and offer spreads are wider, volumes are lower, the time gap between you entering an order and it getting filled or executed might prolong. Which means for micro trend traders who get in and get out multiple times a day with small gaps, they are called scalpers. Their turnover will fall because they'll be able to rotate their capital a few times less during the day. That again means a smaller take home profit. Here again, there are solutions. I'll come to it when we reach that segment in this video. Now, in statistical analysis, this process of entering and exiting is called ingress. Ingress is enter, egress is exit. Your ingress and egress might become a little challenged. Is that a worry? Yes, it is. It definitely is. There are solutions. I wish it hadn't happened, but it's happening. We'll have to learn to live with it. Now let me talk about a problem that I would face as a real world trader. I could be looking at monetizing my existing portfolio of delivery based shares that I own by earning a certain amount of interest on it. These are called covered calls. So for example, I could be owning 5 lakh rupees worth of stock A. All right. And if it is in the FNO list, what I could do is, and the stock A is being traded at 500. In the FNO list, what I could do is I'd say, okay, let me see how many calls there are available at far higher strikes. I find 550, 560, 570 calls available. What I do is sell those calls. Remember, I told you option writers make more money in option trading video number 1. Please do check that out. Now, why am I selling call options of the stock that I own in physical? Because it's trading at 500. I'm selling a call at 550, 560, 570. In my future videos in options trading, we have released only 2 of them. I will also tell you which strike to choose and why. I will share the reasons with you. So if I sell a 570 call, I'm assuming that it won't go there, which means the entire premium will go in my pocket while I keep the share in my portfolio. It's earning me interest. And if I've pledged the share as collateral, I can use it as 50% of the span margin payable and 50% more by way of cash. So for a little amount of investment, I can keep earning interest every month. Now, so far, so good. Your market lot size currently is 5 lakhs. If it goes to 20 to 30 lakhs, what happens to those investors who don't have physical shares worth 30 lakhs? Because you'll have to hedge with the minimum market lot. Now, what happens is, supposing you're owning 5 lakhs worth of shares and the minimum market lot is 20 lakhs, you write a deeply out of money call, fine. But you've hedged only 5 lakhs, the remaining 20 lakh exposure is actually not a delta neutral strategy. It's a naked short. So God forbid anything goes wrong and the market was to jump, you would lose a lot more money than you would have earned by way of writing these options, because you had 5 lakh rupees of deliverable securities and you hedged it with 20 lakh rupees worth derivatives. That's a factor of 4. Now, this is what a big lot size can do. It can basically eliminate a lot of small guys from doing covered calls. My last video that I released was on tail risk strategies, or the hacienda hedge strategy. Extremely popular with all institutional, retail, high net worth individuals, and very profitable as well. This will again have the same problem as covered calls. Now you have 5 lakh worth of shares. You will want to implement a tail risk strategy or the hacienda hedge strategy, but your market lot is now 20 to 30 lakhs. So you're only delta neutral or covered or hedged to the extent of 5 lakhs, and the remaining is a naked position. Here again, you're going to have a problem. Is there a workaround? Yes, I think there is a workaround, and we are going to come to that. Be patient. Friends, before I proceed any further, I want you to hear out a request that I want to make to you. A request. I don't want any money from you. I don't want anything from you. I do not believe in providing paid services. But my videos take a lot of time, effort, and energy, including money. It would help me a lot if you help me to reach out to a wider audience by sharing these videos with smart traders like yourselves, your friends, your family, your social media groups on WhatsApp, Facebook, Twitter, Instagram, etc. I'm putting in the effort to make these cutting edge videos which are not being made by anybody else. At least make it worth my while by helping me reach out to a wider audience. If you can help me do that, I would greatly appreciate it. Friends, I've talked to you about the potential challenges that may arise. Now, let's come to solutions. Problems are no discussion point here. We are here to find solutions. Number one, and it's not, I agree, I absolutely agree that it's not something that's viable for everyone. But if you can, raise your allocation to your trading without, I stress, without borrowing money. Please do not ever borrow money to trade. It's very risky. Trading by itself is a very risky activity. And if you borrow money to trade, you're multiplying the risk manyfold. And remember what I told you, there are 2 kinds of capital: emotional capital and financial capital. You will deplete your emotional capital when you lose money which is borrowed. So please don't borrow money. However, if you can, raise more allocations. If you can't, well, that's just too bad. Solution number 2, reducing your risk footprint. How? Remember, I made this video recently. How to try and get maximum profit out of each trade that you initiate, that you enter, by waiting for a bigger price move and taking a smaller exposure. What that does is, it protects your downside if things go wrong. You will lose less money on a small exposure rather than lose a huge amount of money. Like I gave you an example, there are 2 ways to make 10,000 rupees profit. Buy 10,000 shares, wait for a $1 move, you made 10,000. Buy 1,000 shares, wait for 10 rupee move, make 10,000. Many of you will say, Vijay, it's one and the same. I'm sorry, I beg to differ. When you buy 1,000 shares waiting for a 10 rupee price move, you have a lower risk footprint. You will lose less money if things go wrong. If you have a 10,000 share exposure and something goes wrong, bang, big loss. So leverage is a knife that cuts both ways. Now, when the lot sizes are increased, play on minimal lots, wait for bigger price moves. You're as it is having a big footprint because the lot size is increased. At least don't take multiple positions. Solution number 3. I told you that covered calls and hacienda hedges are going to become a challenge because of the disparate exposure in your physical and in your FNO exposure. Now, if you have 5 lakhs worth of shares and you're going to use a fat tail or a hacienda hedge tail risk strategy of 20 lakh rupees, you will be wondering, what about the remaining 15 lakhs? I'm actually naked short here. What do you do? Solution number 3, you may want to basically raise the level of your game by delta hedging. Now you have a delivery of 5 lakh rupees worth of shares which are priced at 500. You could basically do the following. You could write calls at say 600. Examples are hypothetical. At 600, unfortunately, you're not taking an exposure of 5 lakhs, which is how much you own the shares, but 20 lakhs, which is what SEBI decides the minimum market lot size should be. All right. So you're net naked short by 15 lakhs. What if you could also sell the puts of 50 rupees? When you're selling a put, you're going long. Now, what will happen? You might think that you will be forcefully subjected to higher allocation of money. No. Because you're selling a call which is short and you're selling a put which is long, this would become a delta neutral strategy and the exchange reduces the margin on the other leg. And now you're basically covered to an extent. I completely agree with people who tell me that there is no such thing as a perfect hedge. Whenever you hedge your position and go to sleep assuming that all is well, a fat tail event like 2008 or the COVID lockdown or 4th of June 2024 election result day will come and take your shirt off. Agreed. But it doesn't happen every day, and we are talking about mathematical probabilities, not certainties. We are trying to work around. Will there be other solutions? Yes, there might be. We are in a process of living and learning because we don't know what exactly will be implemented. We are now brainstorming, you and me. We are discussing what are our solutions and options available to us. The fourth solution that I mentioned on my social media accounts, please, I implore you, please learn to read your trading terminal screen. Screen reading as a skill is what will save you from disaster because you will be able to catch market turnings immediately when you read the screens. There is nothing faster than the price, and unless you know how to read the price, you don't know how to read anything at all. Now, what will happen when you learn screen reading is, remember what I told you about the tick list. The tick list will be slower, which means there will be fewer transactions. Now, let me tell you something that happens to us as real world traders. We, on an average day, are parsing through more than 60,000 trades a day. And I'm not talking about all the FNO stocks that are in the play here. I barely watch 6 or 7 stocks and Nifty and Bank Nifty. So 8 to 9 items at the most. But we are forced to look at 60 to 70,000 trades per day. Of course, our in-house statistical model IBEX does that for us. And for the behavioral aspect of MWPL, etc., we have the behavioral model Barracuda. They do the work for us, but the fact remains that you need to be basically vigilant and it's time consuming. 60 to 70,000 trades will then fall to 40 to 45,000 trades because they will be fewer in number. So what will happen is your decisions will be faster. What you will basically lose out on in terms of time lag in ingress and egress, entry and exit, you will gain in terms of emotional capital, quicker decision making processes because data parsing will be faster. That is a major solution as far as I'm concerned. Friends, making money has never been easy. In my video on what if taxes are raised, I put you through the history of how we went from 2 lakh rupees lot sizes to 5 lakh rupees in 2015. Even that time, your span margin and mark-to-market margin requirement went up 2.5 times because from 2 lakhs it went to 5 lakhs. We've gone through telescopic margin increases. We've gone through exposure margin increases. We've gone through peak margins. We've gone through collateral and leverage reductions, and we've come out trumps. We've done it before. We are traders. We work around. We adapt, provided we don't submerge ourselves with worry. Frankly speaking, I have zero time for worrying because I'm ideating, I'm thinking of how to basically rub shoulders with the high frequency traders, the algo traders, the artificial intelligence traders from abroad who are inevitably winding up, landing on our shores and setting up their prop trading desks here. Worrying will get you nowhere. Finding solutions might give you a chance. That is what we should focus on. Friends, before I wind up this video, a reminder to subscribe to my YouTube channel if you haven't already done so. In the comment segment, do let me know what you think of my work and how it helps you become a better trader. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And please share my video with smart traders like yourselves so that I can reach a wider audience. Thank you for your patience and being with me in this video. Till we meet again, this is Vijay Bhambwani signing off for now. Have a very profitable day ahead. Take care. Bye-bye.